Hi, in this video we'll introduce the capital asset pricing model, or the Capm. So as we have seen before, with the part on diversification, the investors cannot diversify away the market risk or the systematic risks. So they're basically rewarded or compensated for bearing the market risks themselves. Any other idiosyncratic risk is not going to be compensated because they can just diversify away the risks themselves. So with that in mind, let's take a look at the capital asset pricing model here. So without going into the lengthy mathematical derivation of this conclusion here, or the equation here, we'll try to explain this in a very intuitive way. So since we're not compensated for any idiosyncratic risks, then we must be compensated for the market risks that we are bearing. So any asset in the market or any stocks in the market can only be compensated for its market risk exposure here. So how exposed it is to the whole market risk or the systematic risk decides the expected return for the stock itself. So let's take a look at this equation here. We have the risk-free rate here, and we have this beta of K, or asset K, and then we have the RM minus RF, RM here being the market return, and the RM minus RF means how much is the financial market or the whole market earning as the expected return higher than the risk-free rate, or sometimes we call this the market premium. Okay, so this is the market premium. All right, so we need to capture the relationship between any stock or any risky asset in this market with its exposure to the market premium. So the intuitive way to do it is to run a simple linear regression here. So beta here is more or less the same as you would see in econometrics or statistics, which is the coefficient that you get from a simple OOS regression here. So the beta here is going to be calculated as the covariance between your RK, or your risky assets return, and the RM, which is the return for the market here, and divided by the variance of the market here. Okay, so this is the same way you calculate any betas in your simple linear regression. So this becomes a regression model, right? It becomes a linear regression model. So it tells you what is the expected return for any asset depending on its exposure or co-movement with the market premium itself. Okay, so for this to work, we have to make certain assumptions. This is something that we need to discuss, and if we don't care about the derivation, then at least we need to know the assumptions that Capm needs that for the Capm to work. Okay, so the first one is that we can borrow and lend at the same risk-free rate, which is the same from the capital asset capital allocation line, right? So remember, from our efficient frontier, we can always borrow and lend at the same risk-free rate. Okay, and then there are no transaction costs or taxes. No transaction costs or taxes. Okay, so with these frictions, or sometimes you'll see these things called as frictions, investors will make different decisions here based on how much the transaction costs or taxes would be. Okay, and in reality, these are quite a big issue for any investors to consider. Okay, but here, for a very frictionless, ideal world, something that you would compared to physics as well. So in a world where there's no friction, anything like that, we're constructing something very similar to that as well. So it's a very idealistic world for our theory to work. Okay, but here the third assumption is that we only have a one-period investment horizon. So we don't consider what's in the future or in the past. It's just one period. Okay, so one period investment horizon. So if you make the investment decision, that's it. So there are no further or multiple investment decisions in the future. Okay, and number 4, we can only buy publicly traded assets. So everything is publicly traded. So this coincides with the market risks, right? So if you're not in the market, then this model does not work. So that corresponds to the private equity part of things. So if you are public traded, then you are listed on any stock exchange, for example, London Stock Exchange or the New York Stock Exchange, then you become a public traded stock. So if you're not listed or you're not public, then this model, at least for now, does not work. Okay, or does not work efficiently. Okay, and the 5th assumption is that the investors are rational and they only care about the mean variance optimization. Okay, so everyone would be rational mean variance optimizers. So remember our Sharpe ratio, which is basically optimizing the mean variance relationship. And here we assume the same. So investors care only about the Sharpe ratio. So they're not going to care about the minimum variance portfolio or the highest return. They only care about the efficient outcome where you balance the mean and variance. So we call them mean variance optimizers. Okay. And the last one is that there is no information asymmetry and everyone holds the same belief. Okay. So no information asymmetry. And everyone has the same belief towards the market. Okay, so information asymmetry here means that some investors would hold more information than the others. Okay, but here we're assuming that everything or every possible information is available to everyone, to every investor. Okay, so with these 6 assumptions, then the Capm could work. Okay, but as you can see, these are very, very strict or very you can say unrealistic assumptions. But then why do we still use Capm? It provides us with a very good starting point, or at least theoretically supported starting point. Okay, so in the exam or in any problem sets or practice questions, you might run into or you will most certainly run into questions on Capm. Either it's just asking you to list all the assumptions, so you need to memorize these mechanically. Okay, and then you could be thrown at into some of those numbers here, right? So if I give you the numbers, let's say the RF here is 4% and the beta here is going to be 1.5 and the market return is, let's say, 20%. So what is going to be such an asset's expected return? So all you have to do is to plug in the numbers if the data here or the information is given that way. Okay, so for example, let's just use RF here as 4%. Okay, and I have some asset beta K here, which is 1.5, and I have RM here as 20%. So what is the expected return for this asset? So let's just plug in the Capm. So 4% plus 1.5 multiplied by 20% minus 4%. Okay, so that's going to be 16%, and that's going to be 24. 24 plus 4 is going to be 28%. Okay, so the rest of it is just calculation, right? And sometimes you can be asked to do the other way around. The question gives you the expected return of the asset, and then it leaves out the beta here, or it leaves out the risk-free rate here. So you have to work backwards. But as long as there's only one spot here missing, you can always work it out with what was left of information here. Okay, so this is very basic introduction to the Capm, and we'll look into Capm in more detail in the next video. I'll see you there.